Okay. Welcome back to Skynet One Forex, and in today's video, we are going to talk about what is quarterly theory. Before that, my name is Michael, and let's get started. So, in today's video, we are going to discuss about what is quarterly theory trading theory, and how we are going to use this to guide our trading patterns or trading strategies in the course of this year, or the remaining factor or course of this year. So in today's episode, we are going to talk about market cycles, momentum and precision, and how we're gonna use quarterly trading for more profitability. So I've prepared this for live trading sessions, strategy talks, and market review, and it's going to cover the second quarter to the third quarter of this year. Okay, so let's get started. Now, one may ask, what is quarterly theory? I hope by now you guys have come along with this term on other platforms, even if you search in Google to give you a lot of research results. So there is a kind of framework that was developed many years ago by the expert traders in Wall Street, where they used to trade high frequency trading and really help them. So in this chapter, we are going to introduce it to how we are going to get market insights and practical tools for traders that is going to prepare us for the quarter ahead. Now, in every year, there are four cycles. We have the first quarter, the second quarter, the third quarter, and the fourth quarter. So, as a trader, you need to know this kind of trading quarters so that you can get along with it. Currently, I'm inside, so if you hear any noise, it's just the next door neighbor just doing their own business. Yeah. So that's just by the way, and let's continue. Okay. So in the quarterly trading format or the strategy, we have four formats. Okay, we have four phases in every market, whether it is crypto, whether it's forex, whether it's futures, any kind of market has four phases. Okay, so in today's program, we're going to use this phases to explain what we're gonna need to do when we use the quarterly trading style in our videos. Okay, so the first phase is what we call accumulation, followed by expansion, distribution, and reversion. Okay, so someone will ask, what is accumulation? We've all learned back in high school that when an object is accumulated, it means it's gathering momentum. Okay, so normally in the market, there are some stages where we need to find out about how we get to identify the accumulation phase of the market, and also with that we can be able to what find out the expansion, distribution, and what and the reversion stages. Okay, so there are some focus that we need to implement in this kind of theory. We need to apply smart money concept to track institutional footprints. Okay, by now we should know how to identify liquidity graphs, and also spot internal and external ranges, and also how to identify breaker blocks and other blocks for entries. Okay, in the long term, I'll be making videos using a chart live view so that we understand how to identify liquidity graphs, and also spot internal and external ranges, and also how to use breaker blocks and other blocks for entries. Okay, so let's come to the next subtopic, that is the multi-time frame confirmation. Now, normally, we normally kind of like have each and every trader have his own entry time zone or time frame. So normally, someone will probably say, "I for me, my time zone that I used to enter my trade is the 30 minutes time frame, and someone will say it is 1 hour, 4 hours. Yeah. Now, with the kind of trader that you are, it depends on your trading style. If your trading style matches with how you live your day-to-day life, then you have to what to train yourself to one particular trading style that you have to know. So in the multi-time frame confirmation under this strategy, that is the quarterly theory, it says you have to combine the daily, the 4 hours, and the 15 time frame to confirm structural shift. So in the nutshell, we need to adjust our focus from the daily to the 4 hour and the 15 minutes time frame. It didn't say 5 minutes, it didn't say 15 minutes, it didn't say 30 minutes. Yes. We need to adjust, and also we didn't say 1 hour. So with this kind of trading strategy, we need to adjust our focus. When if we are finding for our daily setups or our entrance or our entry point, we need to what work within this time zone. That is the combined daily with the 4 hour, then the 15 minutes time frame. And with the daily, we use to check the daily bias of the chart. Okay. And with the 4 hour time frame, that is where our main setup is located. So it tells you that if you are able to find your entry, it means the risk to reward ratio is very, very high. That is, you may be getting 1:6, 1:7, 1:5. Yeah, it depends on how you are able to identify the the smart money concept, that is the liquidity grabs, the internal and external ranges, and the breakout blocks and the other blocks for entries. So as I said, in our next video, we are going to do a live analysis using the quarterly trading aspect so that we can get a proper view of it. Okay, and under the third session, we need to what understand that there are some key indicators and tools that we need to what we need to be abreast with so that we can be able to find out how we are going to implement this strategy in our trading style. So the first one under the key indicators, tools and options is the volume profile. In every market, there is a volume. There are volumes. Okay, the volume determine how the traders, the world trader, the retail traders, and institutional traders are buying or selling. And also, we need to identify what are fair value gaps, and also we need to what find out exponential MA. Okay, to also to determine our dynamic trend and support resistance, and also we need to anticipate for liquidity sweeps. Yes, normally in my trading experience, when I find out that there's a liquidity sweep coming, I just get scared because not just scared for myself, but I just get scared for those that are having the weaker hands in the market. So normally, it's kind of a bit very sad to see someone having a perfect entry, perfect setup, later to find out that there was a liquidity sweep and the person may lost and the trade will go to the person advantage, although the person saw the trade. So normally you need to understand that risk management is very, very, very key, and you need to play a future scenario that in case this should happen, what are you going to do? So that's where risk management and discipline comes in. Okay, and the last indicator part is what we need to know is that we have to also be abreast with this knowledge. That is the inner circle trading tools like the breaker blocks, the PD arrays, and Judas swings. Okay, so these are very, very entitled topics that I'll be making more explanations on it in the coming weeks. So guys, before we get to it, make sure you like and subscribe and comment any conclusion or any question that you have. Okay, you comment whatever they are thinking of or your expectations for the video that you'll be doing next. That will help me to even do more detailed explanation. Don't forget to like and subscribe so that we can help our channel to grow. Okay, now under the fourth aspect, okay, we have trading ties by quarter. Okay, so normally in this quarterly trading format, okay, we have something called swing trades. Swing trades normally takes between 2 to 10 days, and yeah, it's very fantastic because you can be able to what, expand the trend of how the market is going, filter out market noise, and also make sure that you are right in the institutional traders playbook. Okay, because normally the institutional traders are smart the retail traders. So if you are able to understand how this market moves, you may be going along with them, and your profitability rate is going to be very high. You may even get up to 98% profitability rate. So normally we advise traders who are very experienced to gauge a certain day range, that if you are going for one pair that you need to get profit on it, you need to make sure that you're going for it. Some traders may go for multiple pairs, aiming for small profits, which later may blow the account. Yeah. So and the most painful aspect of every trader is to blow his or her account. It's very sad, yeah. But what are you going to do? You're going to just sit down and watch how the market is discipline. Okay, so under the swing trade, we need to also target trend continuations and trend reversals. Yeah, normally with the trend reversals, it entails a lot because if you don't take care and care is so taken, when the market reverse against you and you are not able to figure it out, you may lose a lot of money if you're not using no risk management. But if you're using risk management, that's where you learn. Okay, so this is how the market played out. I went for this, but the market went this way. So yeah, you need to what, go out and analyze how this trend patterns and reversal works. Now with the next one, we have the intraday strategy. The intraday strategy. Now, it tells us that we need to focus on the New York open session. That is between 11 a.m. and 8 a.m. EST. Okay, and it may depend on the time zone that you are in. So, if you are in the UTC 00, that's the GMT London time, you need to be checking very early in the mid hours of 5 to 6 a.m. to 7 a.m. Yeah, you need to be abreast at that time so that we can get how to structure or find out these sessions. And you need to what, use kill zones, market opens, and volume shifts. Okay, so this is a PDF which I'll be sharing very soon. If you want to get a copy, just comment and I'll send you the download link so that you can have a look at it. Okay, now there are some risks that comes along with every strategy. As I said in my previous video, there's no strategy that is 100% secure. So you need to figure it out that even the professional players in the forex industry always tell you that there are going to be losses. Yes, they're going to experience losses. So as a trader, you need to be psychologically what, prepared for that. But if you are getting more losses than wins, then it means you need to step out and analyze yourself, analyze your trading style. But if you are getting wins and getting losses along the way, you should be at least 70-30 or 80-20. Okay, you can't be getting 50% losses and 50% profit. It doesn't make sense. It means you are just in the middle. Okay, so as a trader, you need to aim for a certain percentage in profits, either 80, 70, or 90. Okay, so there are some risk events that outsmart this strategy. That is one. When you have the almighty NFP, yeah, the non-farm payrolls, and the consumer price index, that is the CPI, and the FOMC, that these are high volatility catalysts. Okay, so normally if we went for any news, okay, and we see that okay, this is about to happen. Now what happened is that the NFP, the CPI, and the FOMC, we structure the environment into a particular phase. So normally it may in the current session, it may be in the accumulation phase, but all of a sudden This key market news will change the whole structure into a new format. So as a trader using this style to trade, you need to identify that okay, the market was in this phase now because of this news, it has get to this way. So what thing I need to do? I need to what restructure the whole format again so that you can be abreast with the trend. But if you likely continue with your original structure before or after the market news has been erupted, you may have yourself wanting. And another strategy that you need to what you need to know is that you only enter after liquidity sweep and confirmation. Okay, so in the next video, I'm going to talk a lot about how we are going to identify this stuff so that as you get along with it, you may be able to find out how we are going to get more on it and also get more profitable. Okay, now under the risk management theory, okay, under the quarterly trading style, one, it allocates five methods that we need to get to know about it. So one, we have the capital allocation, and it tells us that you need to split across weeks or setups. Okay, it says that there's a program that says that you can't put all your eggs in one basket because if your basket gets stolen, what do you have? We have nothing. So normally for the professional players, if someone is having at least maybe $500 or let's say maybe a beginner trader $500 or $1,000 or an expert trader who may have $100,000, they shift or they divide the money into parts into different accounts. Okay, and they apply the same risk management. So even if the market moves against them, they won't suffer. Okay, because they have uh, managed portfolios that they attend to. And also in every trade, you need to risk 0.1, sorry for that, 0.5% to 1%. Yes, that is the risk management theory under the quarterly trade. So it tells you that no matter what you do, if you follow this theory, hmm, your win rate is going to be very high because it is a blueprint that we need to get to know and understand that with the risk management theory, you need to risk only 0.5% to 1% depending on the setup grade. Okay, so the next aspect is you have to adjust with your win rates. If you see that this trading strategy is moving well with you, is gradually giving you profits, then you need to increase size with consistency. If you started with 0.02, you move to 0.03. You don't move straight to 0.1. That makes it inconsistent. So you need to move consistently in a consecutive manner. And another rule is that if you take the trade using this strategy, then you get three losses. You need to take a break. You need to relax. Analyze what went wrong and don't give up. Okay. Normally most of the traders when one or two trade don't go well, they try to force themselves to get the right thing. And excuse me to say you are losing capital and the capital will not come back again. You can't force the broker to give out your lost capital. So normally it's advised that if you are trading a trading style and you get three losses, it's advised for you to what? To take a break. Take a break. Even machines rest. And how much will about human beings. So even if machines doesn't rest, they get heat up and they have to shut down to come back later. So in every strategy, we need to what take what rest if there are consecutive losses, and you have to get a trading manual. Yes, or trading journal. Normally, most of us don't have even a single note or an exercise book that we used to what we used to track our entries, our buyers, our motions and results. So for every trade that you take, you need to give yourself a specific reason. Okay, I'm taking this trade because I have tracked an entry. Okay, and I know that the market is in this bias. Okay, and what is my emotion when taking a trade? You note them down. And later, what was the result after taking that trade? As time goes on, you get to realize that okay, sometimes it's your trading psychology that influence your trading style. And as time moves, we are going to learn more about it. Okay, so there are some case studies that we are going to know about it. So as I said, I'm going to include all this in our next video. So guys, be prepared. On Friday, we are going to do a live gold trading session so that we get to understand how it moves. So we are going to do one example on gold, then later we are going to do another example on Euro USD. Okay, so that we can see how we have post sweep CPI sweep, and that is today. We have CPI news that is coming out today, so we need to prepare for that. And also, we are going to use this strategy in analyzing most of our trades. Okay, so in conclusion, we say that the market evolves. Okay, so should you use your strategy? You should use this theory as a base, but adapt to it quickly. Discipline plus data gives you a long-term edge. Normally, there's the professional traders that we have in town. Most of them are very disciplined and they deal with a lot of data. Before you take any decision, you need to base on the facts or on a group of information on the data that it's because of this data that I'm taking this decision. Just wake up and say that, oh, I'm just taking it because I see this and this and that. Nah, you need to fool yourself that I am sure of what I'm doing because of I'm seeing this and that because the reason why I'm taking this trade. So, as I said, the market is dynamic. Dynamic. The market evolves. So the market cannot be static, as you may say it, and the markets will not always play out to your book. Today, you may be able to identify the structures and the patterns. Tomorrow, you come and things are different. So the market evolves, and you need to be on the lookout. Okay. So yes, I think there are some questions that we need to ask ourselves. One, what is the bias? There are some trading checklist that we need to do. One, before you take a trade, what is the bias? What's the bias of the trade you're about to take? Where's the liquidity? Is there liquidity that you need to find out? It's up to you. And has the market make a sweep or made a sweep? All these are the what? And the intelligent stuff that you need to know. And four, are we inside or outside the Q zone? Normally, people take trades which are not profitable normally outside the Q zone. The Q zone is where you need to enter very fast and make adjust your LSL and your TP or make your risk parameters or risk management parameters set. So normally if you're inside the Q zone, it means you're in good terms of what? Gaining a lot of profit. So guys, this is today's video about quarterly theory, and in the likewise video coming up in the weeks to come, I'm going to brief more on it step by step so that you get the full concept of it. Okay, so thank you very much for having me today. My name is Michael, and we are shutting off.